And Barloworld has delivered what it calls a pleasing annual performance. The diversified industrial group posted a 5.5% increase in headline earnings per share from continuing operations, citing strategy execution and better than expected trading as one of the factors that boosted its performance. Business Day TV's Ndawuleng Lechela caught up with the Group CEO Dominic Sewela and started off by asking him to take us through the factors that boosted growth during the annual period. Here's what he had to say.
I think, fundamentally, the one that has been pleasing the most has been Equipment Southern Africa. This is at the back of, revenue coming from, selling, machines. Mm-hmm. Machine sales year on year was up 69%. The overall revenue for the group, for the equipment division, was about 35%. That is the first one. And this is the back of the backlog, in the mining sector where, the mining industry was not investing in new equipments. There was a lot of machine aging, so over the last 2 years, we've been delivering equipment into that sector. I think, this year was the highest we've delivered. And also, there's been a lot of civil works, that is being done, particularly on the energy sector, given the challenges that our customers are facing, in terms of power outages. That has led us, to deliver just both, more machines for civil works in the construction industry, as well as selling engines into, markets for data centers and for some of our, B2B customers. But secondly, we saw Mongolia, producing stellar results, at the back of the fact that last year China was a closed border. As the borders opened, the demand for commodities, particularly like coal and copper, into the China market, helped us really lift the results in Mongolia.
Sticking on the commodity prices, now we're starting to see those prices coming down, and that Chinese recovery that we expected is slower than we initially expected. Has that started to filter through into the operations and the businesses?
Yeah, that's why we've given an indication that when we look forward, 2024 is likely to be, slightly tepid. Mm-hmm. In that you can even see in our order book, is dropping from about 5.5 billion to 3.7 billion. That speaks to, the challenges, globally, where the economic forecast, for markets like China is slowing significantly down. Unless they come up with a stimulus package, we don't see things turn. And I think the current commodity prices are indicative of that, supply and demand changing more, with less demand, and that's reflected in the price. So, however, having said so, I think you'll see our numbers in the new year, mm-hmm, basically shifting to the aftermarket, which is more profitable for us, and therefore, we are pleased that, we will still be able, having delivered all these machines, to see us harvesting on the aftermarket.
I mean, the upbeat business has been kind of offsetting, well, especially the Mongolia business has been offsetting what the declining revenues from the Russian unit. And I know Barloworld has been quite adamant, saying that they're not going to exit operations or exit that region anytime soon. But how long can Barloworld withstand these conditions, especially as Russia continues to be hit by those sanctions?
Yeah, I guess, one of the key issues for us, I mean, we've been around for 120 years and, operating in emerging market. It's one of the resilience that we as an organization, from a diversified geographic environment, and a portfolio in the equipment space, because, we operate in about 10 countries in Southern Africa, and Mongolia and Russia. So at any given point in time, there's one market that's down and the other one is up. Mm-hmm. So having said so, our view is that, we will stay as long as it's safe to be in Russia, as long as we're not losing money in Russia. Obviously, should the sanctions continue to tighten, to a point where we have no customers to serve, then it would not make business sense for us to remain in that. But currently, my view is that, notwithstanding all the challenges, we continue to service our customers in that territory, and we're hoping that things would get better, but you can't give yourself hope. But fundamentally, as long as the business delivers, results above, break even, we're happy, because we've already taken the pain in terms of impairment, mm-hmm, to that business. Mm-hmm. So, and it's something that myself and the board continuously watch and discuss from time to time. And if things change one way or the other, we'll take different decisions.
Now, Barloworld has finally exited its non-core assets and has more cash on hand. Are we looking at acquiring anything else?
I think, our view in terms of acquisitions, first and foremost is that if there are assets that meet our guardrails in terms of returns, in terms of price valuation, definitely we will look at those. But generally, I'm not the kind of person who likes overpaying for assets because you take the pain. It's easy to actually get revenue growth and then talk about HEPS growth. But if you think about returns and cash generated for us, that's a key guiding principle. And therefore, if there's nothing that comes through, we'll return the capital back to the shareholders, by way of share buybacks. Alternatively, also looking at saying, when you look at gross debts, gross debt for the organization still elevated in the current high cost of capital, probably opt to pay down the debt.
All right. So before I let you go, I just want you to talk us through the growth we've been seeing in your consumer business.
I guess, the consumer business, reflects basically SA Inc. from a consumer side. I think, consumers in South Africa are taking a lot of pain. If you look at those segments that have been impacted, like coffee creamers, and the food export market, from a paper point of view, that speaks to the challenge that consumers are facing. Because our customers, our B2B customers are the ones that are manufacturing to the consumer market, and they've been hit by power outages and challenges on the water side. So we've seen basically demand from them slowing down. But we also had, other internal, problems, in terms of, maintenance, because when we bought this asset, the previous owner of the asset didn't really put much in terms of investment in CapEx and preventative maintenance. So we are basically investing in that. And our view, next year, certainly we'll see, improvement as we started seeing in the second half with that Jameson factory.
That was Barloworld CEO Dominic Sewela.